Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only. The goal is to empower you with knowledge, but you should always consult with a qualified professional to discuss your specific, individual circumstances before making any financial decisions. Your situation is unique, and you deserve advice tailored directly to you. You just got your license. You saved up, you bought your first car. Maybe it's a 10-year-old Honda, maybe it's your parents' old sedan, but it's yours. It's freedom. It's the key to your first real job, to late-night drives with friends, to not having to ask for a ride ever again. You feel that surge of independence, you can almost taste it. And then you get your first car insurance quote. And the world stops. $300 a month? $400? $500? Suddenly that dream of freedom feels like a financial prison. Your first thought is, this has to be a mistake. Typo. No one actually pays this much, right? Wrong. And that shock, that feeling of being completely blindsided and ripped off, is exactly what car insurance companies are counting on. They know you're new to this. They know you're excited to get on the road. And they have built a system so confusing, so filled with jargon and hidden clauses, that most young drivers just throw their hands up, sign the first piece of paper put in front of them, and end up overpaying by hundreds, sometimes thousands of dollars every single year. They are banking on your confusion. But that ends today. This isn't just another boring video about insurance. This is your playbook. This is the guide I wish someone had given me when I got my first car. Over the next 10 parts, we are going to pull back the curtain on the entire auto insurance industry. I will walk you through step by step every single thing you need to know to not just get a policy, but to get the right policy at the lowest possible price. By the end of this, you won't just be insured. You'll be smart. You'll be in control. You will know exactly what you're paying for, why you're paying for it, and how to make the system work for you, not against you. So let's start at square one. The absolute basics. What even is car insurance? Forget the complicated definitions. At its core, car insurance is a promise. It's a deal you make with a company. You pay them a certain amount of money every month, called a premium. In exchange for your premium, the company promises to pay for damages if you get into an accident. It's a financial safety net. If you cause a crash and suddenly owe someone $50,000 for their medical bills and a new car, you don't have to declare bankruptcy. The insurance company steps in and pays the bill. That's the core idea. It's a system of shared risk. Millions of people pay into a giant pot of money, and when someone has a bad day, the money is there to cover the costs. Now, why is it mandatory? Why can't you just decide not to get it? Because your decision to drive affects everyone else on the road. If you crash into someone and you don't have insurance, the person you hit is left with a totaled car and massive medical bills they can't pay. It's a public safety issue. That's why 49 out of 50 states legally require you to have, at the very least, what's called liability insurance. We're going to dedicate a whole section to liability later, but for now, just know it's the insurance that pays for the other person's car and their injuries if an accident is your fault. It doesn't cover your car or your injuries. It's purely to protect other people from financial ruin because of a mistake you made. And that legal requirement is the first checkpoint you have to pass to get on the road. Okay, so if it's just a big safety net, why does it cost so much, especially for you? This is the part that feels personal. It feels like you're being punished before you've even done anything wrong. But to the insurance company, it's not personal at all. It's just math. Cold hard statistics. Their entire business model is built on one word: risk. They are constantly calculating the odds. What are the chances that you, specifically, will get into an accident? The higher your risk, the higher your premium. It's that simple. And unfortunately for us when we're young, the data is not on our side. Statistically, drivers between the ages of 16 and 19 are nearly 3 times more likely to be in a fatal crash than drivers 20 and over. They have less experience judging distances, less experience reacting to sudden hazards, and let's be honest, are more prone to distractions. Insurance companies see this data. They see millions of data points that say a new 18-year-old driver is a much bigger financial risk than a 45-year-old who has been driving for 27 years with a clean record. So they charge you more. They are pricing in the higher probability that they'll have to pay out a claim on your behalf. It's not a judgment of your personal character or your driving skill. It's a business decision based on a mountain of historical data about drivers exactly like you. Understanding this is the first major key to saving money. You have to stop thinking of your insurance premium as a random, unfair bill. You need to start thinking of it as your personal risk score. And just like a video game, you can take specific actions to lower that score. Everything we're going to talk about, from discounts to coverage types to the car you drive, is all about proving to the insurance company with data that you are less of a risk than they think you are. You are actively managing your risk profile to lower your score and therefore your bill. So let's talk about the very first and biggest decision you'll have to make. This is a foundational choice that can swing your monthly bill by hundreds of dollars. It's the choice between liability only and full coverage. You're going to hear these terms constantly, and most agents will just throw them at you expecting you to know the difference. Let's make it simple. As we said, liability only is the bare minimum you need to be legal. Covers the other guy. If you hit a brand new Mercedes, your liability coverage pays to fix or replace their Mercedes. If they have to go to the hospital, your liability coverage pays their medical bills. It does absolutely nothing for you or your car. If your car is destroyed in the accident, tough luck. You get nothing. If you break your leg, your auto insurance pays nothing toward your hospital bills. It is purely to protect your assets from being sued into oblivion by someone you hit. Full coverage, on the other hand, is a combination of coverages. It includes liability, but it adds two incredibly important shields for you. The first is collision coverage. This pays to fix or replace your car if you get into an accident that is your fault. You hit a pole? Collision covers it. You rear-end someone? Liability pays for their car, collision pays for yours. The second shield is comprehensive coverage. This is for almost everything else that isn't a collision. A tree falls on your car? Comprehensive. Get stolen? Comprehensive. Hail damage, fire, vandalism, you hit a deer? All of that is comprehensive. So the big question is, which one do you need? A brand new agent or a company's website will often push you toward full coverage because it's more expensive and they make more money. But the answer depends almost entirely on one thing: the value of your car. If you are driving a 15-year-old beater that's worth maybe $1,000, does it make sense to pay an extra $80 a month for full coverage? Probably not. You might pay more in extra premiums over a year than the car is even worth. In that case, liability only might be the smarter financial move. But if you're driving a newer car, or a car you just took a loan out for, you absolutely need full coverage. In fact, if you have a car loan, the bank will require you to have it. They want to make sure the asset they loaned you money for, the car, is protected. Making this one decision correctly, based on your car's actual value, is the first and most powerful move you can make to control your insurance costs right from the start. This is the foundation. Understanding that insurance is a game of risk, and knowing the fundamental difference between covering them and covering yourself. But this is just the beginning. The real secrets, the things that separate the people who overpay from the people who get a truly great deal, are buried in the details. Details like deductibles, coverage limits, and a whole list of discounts that companies are required to offer but do a terrible job of advertising. And the most important detail of all is understanding the numbers behind your liability. Because choosing a number that's too low can be a life-altering mistake, a financial time bomb waiting to go off. And that is exactly where we're headed next. So let's talk about those numbers. They're usually presented in a sequence of 3, something like 25/50/25. It looks like a secret code, and in a way it is. It's the code that determines whether a car accident is a manageable problem or a permanent scar on your financial life. To really understand this, I want you to meet someone. Let's call him Alex. Alex is 19. He just got his first real job, saved up, and bought a decent used car. He's proud, he's independent, and he's doing what he's supposed to do: getting car insurance. He pulls up a website, enters his info, and gets a quote. He sees a bunch of options, and like most of us, his eyes drift toward the lowest price. The cheapest option meets his state's minimum requirement. He thinks, minimum requirement? Sounds good enough for me. It's the law, right? If it's legal, it must be safe. He clicks buy, saves about $20 a month, and feels smart. He feels like he beat the system. A few months later, Alex is driving home from work. It's been a long day. He's tired. His favorite song comes on the radio, and he's tapping the steering wheel to the beat. Then his phone buzzes. It's a text from a friend. He knows he shouldn't, but he glances down. Just for a second. But a second is all it takes. When he looks up, all he sees are bright red brake lights. The car in front of him, a brand new SUV, has stopped suddenly. Alex slams on his brakes, but it's too late. The sound of screeching tires is followed by the sickening crunch of metal and the explosion of his airbag. Everything is chaos for a moment, but then it gets quiet. Alex is shaken, but he's okay. He gets out of his car, which is now a crumpled mess. The driver of the SUV, a man, is getting out too. His wife is in the passenger seat, and their 2 kids are in the back. Thankfully, everyone seems mostly okay, just shaken up and sore. The police arrive, reports are filed, and eventually, tow trucks haul the vehicles away. The next day, the phone calls start. And this is where Alex's $20 a month savings becomes the most expensive decision of his life. Let's break down that secret code on his policy. 25/50/25. The last number, the 25, stands for property damage liability. It's the maximum amount in thousands of dollars that his insurance company will pay to repair or replace property he damages in an at-fault accident. In this case, the property is that brand new SUV. A week later, the other driver's insurance company calls Alex's insurance company. The SUV is a total loss. It can't be safely repaired. The value of that vehicle, a new family SUV, is $50,000. Alex's policy has a 25, meaning it covers up to $25,000 in property damage. So, his insurance company writes a check for $25,000 and sends it to the other party. Their job is done. They have fulfilled their legal obligation under the policy Alex purchased. But the SUV was worth $50,000. There is still a $25,000 difference. Who pays for that? Alex does. Suddenly, at 19 years old, Alex receives a letter from an attorney representing the other driver's insurance company. They paid their client for the full value of the SUV, and now they are coming after Alex to get back the money his insurance didn't cover. He is being sued for $25,000. He doesn't have $25,000. He has a few hundred in his checking account. But that doesn't matter. They can garnish his wages, meaning they can take a chunk of his paycheck every single week until the debt is paid. They can put a lien on any property he ever tries to own. This single debt could cripple his ability to get a loan, rent an apartment, or build any kind of financial future for years, maybe even decades. The financial time bomb just went off. And it gets worse. We haven't even talked about the first 2 numbers. That 25/50th. This is bodily injury liability. This covers medical expenses, pain and suffering, and lost wages for people Alex injures in an at-fault accident. The first number, the 25, is the maximum amount his insurance will pay for a single person's injuries. $25,000. The second number, the 50, is the maximum amount his insurance will pay for all injuries in a single accident, combined. $50,000. Now let's go back to the family in the SUV. The father went to the emergency room and was diagnosed with severe whiplash. He needs months of physical therapy and has to miss work. His medical bills and lost wages come to $30,000. Alex's policy covers $25,000 per person, so his insurance pays out $25,000. The father is still owed $5,000, so they sue Alex for that too. The mother suffered a broken wrist from the impact. She needed surgery and follow-up care. Her medical bills total $22,000. Since this is under the $25,000 per person limit, Alex's insurance covers it in full. For a moment, there's a small bit of relief. But remember the second number, the 50? The per-accident maximum? Alex's insurance has already paid $25,000 for the father and $22,000 for the mother. That's a total of $47,000 paid out so far. The policy has a maximum of $50,000 available for this entire accident. That means there is only $3,000 left. What about the kids in the back? They were checked out at the hospital, and thankfully they only had minor bruises, but the hospital visit and checkup still cost $4,000. But Alex's insurance policy only has $3,000 left to give, so it pays that, and the policy is now completely exhausted. The family is still owed $1,000 for their children's medical care, so they sue Alex for that too. Let's do the math on Alex's smart decision to save $20 a month. He is now personally legally on the hook for $25,000 for the rest of the car's value, $5,000 for the rest of the father's medical bills, $1,000 for the rest of the children's medical bills. Total, $31,000 in debt at 19 years old. A debt that could follow him for the rest of his life, all because he chose the state minimum. This isn't a scare tactic. It's the cold, hard reality of how insurance works. State minimums are a financial trap. They are dangerously, catastrophically low. They are set by politicians, not financial experts, and in many states, those limits haven't been updated in decades. while the cost of cars and healthcare has skyrocketed. Choosing the state minimum is like bringing a squirt gun to a house fire. You're legally there, but you have no real protection. So what should Alex have done? What should you do? You need to raise those numbers significantly. Instead of 25/50/25, consider a policy that looks more like 100/300/100. Let's see how Alex's story changes with these limits. 100/300/100. The last number, property damage, is now $100,000. The $50,000 SUV? It's completely covered. Alex owes nothing. The first two numbers, bodily injury, are now 100 to 300. 100,000 per person, 300,000 per accident. The father's $30,000 medical bill? Covered. It's less than the $100,000 limit. Alex owes nothing. The mother's $22,000 bill? Covered. Alex owes nothing. The children's $4,000 bill? Covered. Alex owes nothing. The total medical bills were $56,000. The policy limit is $300,000. It's not even close. With this policy, the accident is still a horrible, stressful experience. But it's not a financial death sentence. His insurance company handles the claims. They defend him. He pays his deductible, his rates go up, and he learns a very hard lesson about texting and driving. But he doesn't start his adult life $31,000 in the hole. And here's the craziest part. The difference in price between that catastrophic state minimum policy and a protective one like 100/300/100 is often not that much. It might be $30, $40, maybe $50 extra a month. It is the single best investment you can make in your financial security. You are not just insuring your car. You are insuring your entire future. You are building a firewall between your life and one horrible mistake on the road. So when you get that quote, ignore the state minimum. See it for the trap that it is. Your first step, the absolute foundation of your entire policy, is to select liability limits that can actually protect you in the real world of 2024, not the world of 1984 when some of these laws were written. Now, this covers your responsibility to other people. But what about you? What about your car, which is now a wreck on the side of the road? What about your own medical bills if you were injured? Liability insurance does absolutely nothing for you or your property. That is a completely different set of coverages, and it's where things get even more personal and potentially even more expensive. So let's talk about protecting your own investment, your car, your body, because that's where the real financial risk often lies for you, the driver. This is the part of the policy that protects your wallet from your own mistakes, or just from the sheer, random chaos of the universe. We're moving into the section of your policy that covers your own vehicle. There are two main players here, and they are almost always talked about together: collision and comprehensive. Let's start with collision because it's the most straightforward. Collision coverage pays to repair or replace your car if it's damaged in, well, a collision. You hit another car. You back into a pole in a parking garage. You swerve to miss a deer and hit a guardrail. You flip your car taking a turn too fast. If your car is damaged because it made contact with another object or overturned, collision coverage is what you'll use. It doesn't matter who was at fault. Even if the accident was 100% your fault, this coverage is designed to fix your car. Now this sounds great, right? You mess up, the insurance company fixes it. But there's a catch. And it's a big one. It's a word you absolutely must understand to make a smart insurance decision. The deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. Think of it as your copay for a car accident. You choose your deductible amount when you buy the policy. Common amounts are $500, $1,000, or even $2,000. Let's play this out. Say you have a $1,000 deductible. You slide on some ice and slam into a tree, causing $6,000 in damage to your beautiful new-to-you car. To get it fixed, you file a claim. The body shop gives the estimate. You then have to write a check for $1,000. Once you've paid your share, the insurance company will step in and pay the remaining $5,000. If the damage was only $800, you'd pay the full $800 yourself. The insurance company pays nothing because the cost of the repair was less than your deductible. This is the fundamental trade-off of car insurance. A lower deductible, say $500, is great when you have an accident because you pay less out of pocket. But it means your monthly insurance bill, your premium, will be higher. A higher deductible, like $1,500, will make your monthly premium cheaper, But you'd better have that $1,500 sitting in a savings account ready to go in case something happens. For a young driver, choosing a higher deductible is a common way to save money on the monthly bill. But it is a gamble. You're betting on yourself to be a safe driver. So that's collision. Covers damage from, you guessed it, collisions. But what about all the other horrible things that can happen to a car? What if you walk out to the student parking lot after class and find a giant dent in your door from a hit and run? What if a massive hailstorm makes your hood look like the surface of the moon? What if a tree branch snaps in a windstorm and crushes your roof? Or what if, God forbid, you walk out in the morning and your car is just gone? Stolen. None of those things are a collision. And that is where the second coverage, comprehensive, comes into play. Comprehensive coverage is sometimes called other than collision coverage, which is a perfect description. It's for almost everything else. Fire, theft, vandalism, hitting an animal, falling objects, floods, hail. Basically all the bad luck that doesn't involve you actually colliding with another object. Just like collision, comprehensive coverage has a deductible. It works the exact same way. A thief smashes your window and rips out your stereo, causing $900 in damage. If you have a $500 deductible for comprehensive, you pay the first $500, and your insurance covers the remaining $400. So now you know the what. Collision for crashes, comprehensive for chaos. The next and most important question is, do you actually need them? Unlike liability insurance, which is required by law, collision and comprehensive are often optional. But I'm going to give you a very simple framework to decide. First, the easiest question. Do you have a loan on your car? Or are you leasing it? If the answer is yes, then the decision is already made for you. Your lender, the bank or finance company, will absolutely require you to carry both collision and comprehensive coverage, usually with a deductible no higher than $1,000. Why? Because until you pay it off, it's technically their car. It's their asset. They are not going to let you drive around in their multi-thousand-dollar asset without full protection. If you total it, they want their money back from the insurance company. So, if you have a car payment, you must have what's called full coverage, which simply means a policy that includes liability, collision, and comprehensive. End of story. But what if you own your car outright? Maybe you saved up and bought a used car for cash. Congratulations, that's a huge achievement. Now you have a choice to make. And to make it, you need to ask yourself one brutally honest question. If my car were completely destroyed tomorrow in an accident, could I afford to go out and buy another one just like it with cash, without derailing my financial life? If your car is worth, say, $8,000, do you have $8,000 in the bank that you could comfortably spend on a replacement car tomorrow? If the answer is no, or yes, but it would wipe out my entire savings, then you need collision and comprehensive coverage. You are essentially paying the insurance company a small monthly fee to protect you from a massive, sudden, $8,000 loss. For most young people, this is a no-brainer. Your car is one of your most valuable assets, and leaving it unprotected is a massive financial risk. There is, however, a point where it stops making sense. This leads us to a helpful guideline some people call the 10% rule. The rule is this. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's current value, it might be time to consider dropping them. Let's break that down. Say you're driving an old beater that's only worth about $2,500. You can look this up on a site like Kelley Blue Book. 10% of $2,500 is $250. Now look at your insurance bill. How much are you paying per year specifically for the collision and comprehensive part of your policy? If that number is, say, $400 a year, you're paying $400 to protect a $2,500 asset. After you pay your $500 or $1,000 deductible, the maximum payout you could ever get is maybe $1,500 to $2,000. At this point, you might decide it's better to save that $400 a year in a separate new car fund and take the risk yourself. This is a personal financial decision, but it's how people with older, low-value cars can save a lot of money. So, to recap the half of the policy that protects you, liability protects everyone else from you. Collision and comprehensive protect your car from, well, pretty much anything. They work using a deductible, which is your share of the cost. And whether you need them depends almost entirely on if you have a loan and what your car is worth versus what the coverage costs. It seems like we've covered all the bases, right? You're protected if you hurt someone else, and you're protected if your own car gets damaged. You're all set. But what happens when you do everything right, and the other guy doesn't? What happens when the person who plows into your driver's side door, sending you to the hospital, has zero insurance? Or they have the absolute bare minimum coverage from another state that doesn't even begin to cover the cost of your totaled car and your medical bills. That's when you discover the most infuriating, unfair loophole in the entire system. And it's why our next conversation is about a set of coverages that might just be the most important and most overlooked on your entire policy. The loophole is this: the person who hit you and caused all this damage has no insurance. Or, almost as bad, they have the absolute bare minimum required by law, which in some states is so low it's practically useless in a serious crash. You see, we live with a fundamental assumption. We assume that if someone wrongs us, if they break the rules and cause us harm, they will be held responsible. That's how society is supposed to work. But with car insurance, that assumption can vaporize in an instant. Because right now, as you're listening to this, an estimated 1 in 8 drivers on the road around you has zero insurance. 1 in 8. They are rolling the dice, hoping they don't cause a crash, and if they do, well, that's your problem, not theirs. They have no insurance company to call. They likely have no assets to sue for. They become what's known in the legal world as judgment-proof. You can sue them and win $1 million settlement, but you can't get blood from a stone. That court judgment is just a piece of paper. It won't pay your neurosurgeon. It won't pay your physical therapist. It won't cover the months of salary you're losing because you can't work. So you turn to your own insurance company, the one you've been paying faithfully every month. You tell them, the other driver was 100% at fault, but they're uninsured. My medical bills are $80,000. Please help. And if you only bought the basic liability coverage we talked about before, your insurance company will say something soul-crushing. They'll say, "We are so sorry this happened to you, but your policy is designed to pay for damages you caused to others. It doesn't cover your own injuries when another driver is at fault." This is the nightmare scenario. You did everything right. You were a responsible driver. You bought insurance. And you are left holding the bag for someone else's catastrophic mistake. Unless you have uninsured and underinsured motorist coverage. This is it. This is the single most important coverage you may have never heard of. If liability insurance is your shield to protect your assets from others, uninsured and underinsured motorist coverage, often shortened to UM/UIM, is your sword. It's the coverage that lets you fight back when the system fails you. Think of it this way. When you add UM/UIM to your policy, you are essentially hiring your own insurance company to stand in the shoes of the at-fault driver's non-existent insurance company. You are paying your insurer a small extra amount each month so that if you get hit by someone with no coverage, your own company steps up and pays for your damages, just as if they were the insurer for the person who hit you. Let's break it down because there are two critical parts. First, there's uninsured motorist bodily injury, or UMBI. This is the big one. This protects you, your family members, and any passengers in your car if you are injured by a driver who has no insurance at all. It also covers you in a hit and run, where the driver is unidentified and therefore, effectively uninsured. Let's go back to our crash. You're in the hospital. The bills are piling up to $80,000. The at-fault driver is an uninsured ghost. But you were smart. When you bought your policy, you added $100,000 of uninsured motorist bodily injury coverage. Now, instead of facing financial ruin, you file a claim with your own company. They investigate, confirm the other driver was at fault and uninsured, and they cut you a check to cover your medical bills, your lost wages, and even for your pain and suffering, up to that $100,000 limit you chose. You are made whole. Disaster averted. The second and equally crucial part is underinsured motorist bodily injury, or UIMBI. This one is a little more subtle, but it's just as dangerous. This protects you when the at-fault driver does have insurance, but their liability limits are pathetically low and aren't enough to cover your bills. Let's change our scenario slightly. The person who hit you wasn't totally irresponsible. They bought insurance, but they only bought the state minimum. In many states, that minimum for injuring one person is just $25,000. 25 grand. That might sound like a lot of money, but it doesn't even cover the cost of a routine knee surgery. It's a drop in the bucket for a serious injury. So your medical bills are still $80,000. The at-fault driver's insurance company pays out their full policy limit of $25,000. Great, but what about the other $55,000? Where does that come from? It comes from your underinsured motorist coverage. Your UIMBI coverage kicks in to pay the difference between the other driver's low limit and your actual damages, all the way up to your own, much higher UIMBI limit. Do you see how powerful this is? You are no longer at the mercy of the worst decision-making of the drivers around you. You are taking control. You are setting your own safety net. Whatever limit you choose for your own bodily injury liability, that $50, $100, $250,000 you have to protect your assets, you should have at least that same amount in uninsured and underinsured motorist coverage to protect your own body. They should be mirror images of each other. To do anything less is like buying a top-of-the-line security system for your house, but leaving the front door wide open. Now, there's also a property damage component to this. It's called, you guessed it, uninsured motorist property damage, or UMPD. This is designed to repair or replace your car if it's damaged by an uninsured driver. It's helpful, but frankly, it's less critical than the bodily injury part for one simple reason. You probably have another coverage that can do the same job, which is collision coverage, which we'll talk about in the next part. Often, UMPD has a lower limit, say $10,000 or $20,000, and it's really only useful if you don't have collision. For most people, having solid collision coverage is the better way to protect your vehicle itself. So the absolute non-negotiable, must-have, don't even think about skipping it coverages are uninsured and underinsured motorist bodily injury. But there's one more layer to this. A secret level, if you will, that can dramatically increase your protection, and it's something most agents won't take the time to explain properly. It's the concept of stacking. In many states, if you have more than one car on your insurance policy, you'll be given a choice between stacked or unstacked UM/UIM coverage. Unstacked is the default. It means the limit you choose is the absolute maximum you can get, period. If you have $100,000 in UM coverage, that's your cap, even if you have 3 cars on your policy. Stacked coverage is different. Stacking allows you to multiply your coverage limit by the number of cars on your policy. Let's say you and your parents have 3 cars on the family policy, and you have a UM/UIM limit of $100,000 per person. If you choose to stack your coverage, and you get hit by an uninsured driver while driving one of those cars, you don't just have $100,000 of coverage. You have $100,000 times 3 cars. You now have a $300,000 safety net. The extra cost for stacking is usually surprisingly small for the massive increase in protection it provides. It is one of the single best bargains in the entire world of insurance. If you have multiple cars on your policy and you live in a state that allows stacking, you should ask for it. Every single time. I know this is a lot to take in. It's complex, but it's life or death important. As a young person, your single greatest financial asset isn't a car or a house. It's your ability to work and earn an income for the next 40 or 50 years. A single serious accident caused by an uninsured driver can take that away from you in a heartbeat, leaving you with a lifetime of debt and physical challenges. This coverage protects your future. It protects your health. It is the one place on your policy where you should never, ever skimp. Okay, so you've done it. You've protected yourself from the financial fallout of hurting someone else, and now you've protected yourself from getting hurt by the millions of irresponsible drivers out there. You've built a fortress around your finances and your future. But what about the car itself? Your actual physical car. What happens if you're the one who makes a mistake and hits a pole? What happens if a freak hailstorm turns your hood into a golf ball? Or a deer decides to redesign your front bumper at 60 miles per hour? None of the coverages we've talked about so far will pay a single penny to fix your own car in those situations. That's where we get into the 2 coverages that protect your vehicle, no matter who or what is at fault. And the decision to get them or skip them is one of the biggest financial choices you'll make when buying your first policy. These 2 coverages are collision and comprehensive. You'll almost always see them talked about together, and for good reason. In many states, you can't buy one without the other. Together, they're what people are usually talking about when they use the phrase full coverage. Now, I want you to be very careful with that term. Full coverage isn't an official insurance product. It's just slang. It makes you feel like you're protected from absolutely everything, which is never true. There are always limits, exclusions, and deductibles. But for the sake of understanding, when people say full coverage, they generally mean a policy that includes your state's required liability coverages, plus collision and comprehensive. So let's break them down, starting with the big one, collision. Collision coverage is exactly what it sounds like. It pays to repair or, if necessary, replace your own car if it's damaged in a collision with another object. That object is usually another car, but it could also be a guardrail, a telephone pole, a parking garage pillar, or even just the ground if your car rolls over. The most important thing to understand about collision coverage is that it pays out regardless of who is at fault. Let that sink in. If you cause an accident, Let's say you misjudge a turn and hit a parked car. Your bodily injury and property damage liability will pay for the other person's injuries and the damage to their car. But what about your car? Liability doesn't touch it. That's where your collision coverage swoops in to save the day. If another driver causes an accident and hits you, their property damage liability is technically supposed to pay for your car. But what if they're underinsured and don't have enough coverage to fix your brand new ride? What if they're an uninsured driver who flees the scene? What if their insurance company decides to drag its feet for weeks, arguing about who was really at fault? In all those cases, you can use your own collision coverage to get your car fixed right away. Your insurance company will then go after the at-fault driver's insurance, a process called subrogation, to get their money back. You get your car back on the road fast and they handle the headache. But there's a catch, and it's a big one. It's called the deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dollar. Think of it as your share of the risk. Common deductible amounts are $250, $500, or $1,000. Here's how it works. Let's say you have a $500 collision deductible. You get into a fender bender, and the repair shop quotes you $3,000 to fix your car. You will pay the first $500 directly to the body shop. Your insurance company will then pay the remaining $2,500. If the damage was only $400, you just pay it yourself because it's less than your deductible. You wouldn't even file a claim. This is a critical trade-off. A higher deductible, like $1,000, means you're taking on more personal risk. Because of that, the insurance company will give you a lower premium. A lower deductible, like $250, means the insurance company is taking on more risk, so they will charge you a higher premium. For a young driver on a tight budget, choosing a higher deductible is one of the easiest ways to make your insurance more affordable, but you have to be honest with yourself. Could you write a check for that deductible amount tomorrow without it ruining you financially? Now, what happens if the damage is really, really bad? This leads to another crucial concept: actual cash value. If the cost to repair your car is more than the car is worth, the insurance company will declare it a total loss. They are not going to pay $10,000 to fix a car that was only worth $7,000. Instead, they will write you a check for the car's actual cash value, or ACV, minus your deductible. Actual cash value is what your car was worth in the open market the second before the crash. It is not what you paid for it. It is not what a brand new one costs. It is its used, depreciated value. So, if your car's ACV was $7,000 and you have a $500 deductible, they will send you a check for $6,500. Then they take possession of your wrecked car. This is a shock to many first-time buyers who think insurance will magically provide them with a new car. Doesn't. Pays you what your old car was worth. Okay, so that's collision. It covers damage to your car from, well, collisions. But what about all the other bad things that can happen to a car? That's where its partner comprehensive coverage comes in. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It protects your car from damage caused by basically anything that isn't a collision. We're talking about things that are generally outside of your control. For example, theft and vandalism. If someone steals your car or smashes your windows, comprehensive covers it. Fire. Falling objects like a tree branch landing on your roof during a storm. Weather events like a hailstorm that leaves your car looking like a golf ball, or a flood. And the big one that surprises everyone, hitting an animal. That's right. If you swerve to miss a deer and hit a tree, that's a collision claim. But if you hit the deer directly, that's a comprehensive claim. It's a weird distinction, but it's a critical one because comprehensive claims are generally seen more favorably by insurance companies and are less likely to raise your rates, since there's nothing you could have done to prevent it. Just like collision, comprehensive coverage has a deductible. It works the exact same way. If a hailstorm causes $2,000 in damage and you have a $500 comprehensive deductible, you pay $500, and the insurer pays $1,500. You can often choose different deductible amounts for collision and comprehensive to fine-tune your policy and your budget. So now we arrive at the million-dollar question, or at least the several $1,000 question for your car. Do you actually need these two coverages? For many of you, the answer is not up to you. It's already been decided. If you have a loan on your car or if you are leasing it, your lender or leasing company will almost certainly require you to carry both collision and comprehensive coverage, with a deductible no higher than a certain amount, usually $1,000. Why? Because until you pay it off, that car isn't really yours. It's the bank's asset. It's their collateral for the loan they gave you. They need to protect their investment. If you total that car and only have liability insurance, you'd stop making payments, and the bank would be left with nothing but a pile of scrap metal. By forcing you to have collision and comp, they ensure that if the car is destroyed, their loan gets paid off by the insurance settlement. It's non-negotiable. If you try to remove this coverage, they can and will buy a policy for you at a ridiculously high price and add the cost to your loan payment. But what if you own your car outright? Maybe you bought it with cash or you just finished paying off your loan. Congratulations! Now the decision is entirely yours. And it boils down to one simple personal question. If your car were totaled tomorrow, could you afford to repair or replace it without putting yourself in a major financial crisis? If your car is worth $10,000, $15,000, or $20,000, the answer is probably no. A sudden loss of that much money would be devastating. In this case, paying a few $100 extra a year for collision and comprehensive is absolutely worth it. It's a safety net that protects one of your most valuable assets. But what if you drive an old beater that's only worth $2,500? And let's say you have a $1,000 deductible. In a best-case scenario for a total loss, the insurance company is only ever going to pay you $1,500. Is it worth paying, say, $600 a year in premiums to protect a maximum payout of $1,500? Maybe not. You might be better off saving that $600 a year in a dedicated new car fund. A good rule of thumb many people use is the 10% rule. If the annual cost of your collision and comprehensive premium is more than 10% of your car's actual cash value, it might be time to consider dropping them. So, if your car is worth $3,000, 10% of that is $300. If your comp and collision cost you more than $300 a year, the math starts to suggest you're better off self-insuring. That is, saving the money yourself and accepting the risk. It's not a perfect rule, but it's a fantastic starting point for making an informed financial decision. So, you've sorted out your liability coverages, and now you've made the big call on whether to protect your own car with collision and comprehensive. You've built the core of a solid policy. But we're not done yet. There is a whole menu of other smaller coverages that can be absolute lifesavers in very specific situations. They don't cost much, but they can save you a world of hassle and a surprising amount of money when you need them most. Let's call these the a la carte coverages. They're the side dishes of the insurance world, but sometimes a really good side dish can make the entire meal. Picking the right ones for your specific situation is the difference between a good policy and a great one. First up is one of my absolute favorites, and one that people regret not having the most: rental reimbursement. Imagine this. You get into a fender bender. It's not your fault, but your car needs to be in the shop for 2 weeks to get a new bumper and headlight. Now what? How do you get to school? To work? You could take Ubers everywhere and watch your bank account evaporate. Or you could rent a car. A basic rental can easily cost you $40, $50, even $60 a day. Over 2 weeks, you're looking at a bill for $700 or more, just so you can live your life while your car gets fixed. Rental reimbursement coverage prevents this nightmare. For just a few extra dollars a month, literally sometimes the price of a single cup of coffee, your insurance company will pay for that rental car. They'll typically give you a daily limit, say $30 or $40 a day, for up to 30 days. It's an incredibly cheap bit of insurance that saves you from a massive, unexpected, and deeply frustrating expense. If your car is your lifeline and you don't have a second vehicle just sitting around, this isn't an option. It's a necessity. Next on the menu is its close cousin, roadside assistance. We've all seen the movie. The car sputters to a stop on a dark, empty road. It's raining. Your phone is at 5% battery. That's not just fiction, it happens. A flat tire, a dead battery, you lock your keys in the car, it's a matter of when, not if. Calling a tow truck on your own in an emergency can cost you $100, $200 easy. And that's just to get you to the nearest mechanic. Roadside assistance coverage on your auto policy is the ultimate peace of mind button. For, again, just a few bucks a month, you get a 1-800 number to call. They'll send someone to jump your battery, change your flat, get your keys out of your locked car, or tow you to a repair shop. It turns a potential crisis that ruins your night and your budget into a manageable inconvenience. Some people pay for separate services like AAA for this, and that's a great option too, but often adding it to your auto insurance is the cheapest and simplest way to get that 24/7 protection. Don't be the person stranded on the side of the highway wishing you'd spent the extra $3 a month. Okay, so we've covered your car getting fixed and getting you around while it's in the shop. But what about the most important thing inside the car? You and your passengers. This is where medical payments coverage, or MedPay, comes in. Think of it as a small, immediate health insurance policy specifically for car accidents. Let's say you brake hard and your friend in the passenger seat bumps their head, or you need to go to the emergency room for a checkup and have a $2,000 health insurance deductible. MedPay can cover those costs. It pays out for medical and even funeral expenses for you and anyone in your car, no matter who was at fault for the accident. It's typically sold in small amounts, $1,000, $5,000, or $10,000 of coverage, and it's designed to handle those immediate bills without you having to dip into your savings or fight over whose insurance is paying. Now, in some states called no-fault states, you'll be required to buy something similar but more comprehensive called personal injury protection, or PIP. PIP is like MedPay on steroids. It not only covers medical bills regardless of fault, but it can also cover things like lost wages if you can't work after an accident, and even services you might need to hire, like house cleaning, if your injuries prevent you from doing them yourself. The key takeaway is this: both MedPay and PIP are about getting you and your passengers taken care of quickly, without the headache of determining fault first. Alright, let's talk about the single biggest financial trap for young car buyers. This one is critical. It's called gap insurance. And to understand it, you need to understand one painful word: depreciation. The second you drive a new car off the dealer's lot, it loses value. A lot of value. In the first year, a new car can depreciate by 20% or more. So picture this. You buy a brand new car for $30,000. You make a small down payment so you have a loan for $28,000. 6 months later, you're in an accident and the car is declared a total loss. It's totaled. Because of depreciation, the insurance company determines the car's actual cash value, what it was worth right before the crash, is only $24,000. They write you a check for $24,000. That's great, but you still owe the bank $27,000 on your loan. Do you see the problem? The insurance check isn't enough to pay off your loan. You now have no car, and you still have to write a check to the bank for $3,000. This is called being upside down on your loan, and it is a financial nightmare. Gap insurance is the hero of this story. It is specifically designed to cover the gap between what your car is worth and what you still owe on your loan or lease. In that scenario, gap coverage would have paid that extra $3,000 to the bank, leaving you with a zero balance. If you are buying a new car with a small down payment, or financing for a long term like 60 or 72 months, you absolutely, positively need gap insurance. The dealership will try to sell it to you for a high price, but it's almost always cheaper to add it directly to your auto insurance policy. For those who want an even higher level of protection, there's new car replacement coverage. It's a step above gap. If your new car gets totaled, usually within the first year or two of ownership, this coverage doesn't just pay off the loan. It pays to replace your totaled car with a brand new one of the same make and model. It's more expensive, but it's the ultimate do-over button after a devastating loss. Finally, let's talk to the customizers, the people who love their cars. Have you installed a killer sound system? Upgraded to expensive custom wheels? A new exhaust? A vinyl wrap? You need to know that your standard comprehensive and collision coverage will not pay for those things. They only pay to restore the car to its factory condition. All that money you poured into your ride? Gone. That's where custom parts and equipment coverage, or CPE, comes in. You tell your insurance company about the upgrades you've made, and for a small premium, they'll cover the value of those parts if they're damaged or stolen. If you've invested hundreds or thousands of dollars to make your car your own, you need to protect that investment with CPE coverage. Otherwise, you're just gambling with your hard-earned cash. So there you have it. The secret menu: rental reimbursement, roadside assistance, MedPay, gap, and custom parts coverage. Each one is a tool, a specialized piece of armor designed to protect you from a very specific and very expensive type of problem. By understanding them, you can go beyond the basic one-size-fits-all policy and build a shield that is perfectly tailored to your car, your finances, and your life. Now we've designed our perfect policy. We've chosen our liability limits, picked our deductibles, and selected the exact add-ons we need. The suit of armor is complete, but there's one big question left. How in the world do we afford it? Especially as a young driver, the price tag can look terrifying. But what if I told you there are dozens of secret discounts, hidden opportunities, and clever strategies that insurers don't always advertise, which can slash that price by hundreds, or in some cases even over $1,000 a year? Getting the right coverage is half the battle. Getting it at the right price, well, that's where the real game begins. Let's talk about the secret weapon in this game, discounts. These aren't just little $10 off coupons. These are strategic moves that can fundamentally change the price you pay. Think of it like a video game. You're starting on the base level with the standard expensive premium, but there are hidden power-ups and cheat codes scattered everywhere, and your job is to find and activate as many as you can. The first and most famous power-up for young drivers is the Good Student discount. Now, you've probably heard of this, but most people don't realize how powerful or how accessible it is. They hear Good Student and think you need a perfect 4.0 GPA and a letter from the principal. The reality is much simpler. Most major insurers will give you a discount of anywhere from 10 to 25% for simply maintaining a B average or a 3.0 GPA. Some are even more lenient. You don't have to be the valedictorian, you just have to be a solid student. Why? Because from an insurer's perspective, a student who is responsible enough to get decent grades is statistically less likely to be a reckless driver. They see a correlation between responsibility in the classroom and responsibility behind the wheel. So, how do you claim it? You don't wait for them to ask. You proactively send your insurance agent a copy of your report card or college transcript at the beginning of every semester or policy period. Be your own advocate. That 25% can translate into hundreds of dollars a year, just for doing what you're already supposed to be doing. And here's a variation on that theme: the distant student or student away at school discount. If you go to college over 100 miles away from home and you don't take your car with you, you're a goldmine for an insurer. Your car is just sitting in your parents' driveway, barely being used. The risk of you getting into an accident plummets. But if you're still listed on the policy as a primary driver, your parents are paying a premium as if you're commuting every day. By letting the insurance company know you're a distant student, they can slash the premium for that vehicle, sometimes by as much as 30% or more, while still keeping you covered for when you come home on holidays and summer break. It's a massive, often missed saving. Okay, let's level up. We're moving from the academic power-ups to the technology-based ones. This is where you encounter the telematics programs. You know the ones. Progressive has Snapshot, State Farm has Drive Safe and Save, Allstate has DriveWise. They offer you a device you plug into your car or an app you download on your phone, and in exchange for a potentially huge discount, it tracks your driving habits. This is a double-edged sword, and you need to go into it with your eyes wide open. On one hand, if you are genuinely a safe, conservative driver, this can be the single biggest discount you can get, sometimes knocking another 30 or even 40% off your bill. But what are they really tracking? It's not just your speed. They are monitoring 4 key things. First, hard braking. Are you constantly slamming on the brakes, suggesting you're following too closely or not anticipating traffic? Second, rapid acceleration. Are you flooring it from every stoplight? Third, the time of day you drive. Driving late at night, especially between midnight and 4 a.m. on a weekend, is statistically the most dangerous time. They will penalize you for it. And fourth, and this is the big one now, phone usage. The apps can detect if you're texting, holding, or otherwise interacting with your phone while the car is in motion. If you can master these 4 things, drive smoothly, avoid late-night trips, and keep your phone down, you can win the telematics game. But be warned. Some programs, though not all, can actually raise your rates if they deem your driving to be too risky. You have to read the fine print. My advice? If you're considering it, treat the first month like a driving test. Be the perfect driver. See what kind of discount they offer you. If it's substantial, great. If not, you can usually opt out. It's a high-risk, high-reward strategy, but for a safe young driver, it can be a financial game-changer. Next up, let's talk about the bundling bonus and the loyalty trap. You see ads for it all the time. Bundle your auto and renter's insurance and save. And it's true. Bundling is almost always a smart move. Renter's insurance is incredibly cheap, sometimes as little as $10 or $15 a month, and it protects your stuff in your apartment or dorm room. But adding it to your auto policy can often unlock a bundling discount on your car insurance that is more than the entire cost of the renter's policy. You're essentially getting paid to have your belongings insured. It's a no-brainer. But this leads to the trap, the myth of loyalty. You might think that staying with the same company for years will earn you a better rate. The shocking truth is, it often does the exact opposite. Many insurers practice something called price optimization. It's a fancy term for a simple, brutal concept. They identify customers who are unlikely to shop around for a new quote, and slowly, year after year, they raise your rates, betting you won't notice or won't bother to leave. They are penalizing you for your loyalty. The person who gets the best rate is not the loyal customer. It's the new customer. So the strategy is this: yes, bundle your policies, but every single year, or at least every 2 years, you need to reshop your insurance. Get quotes from at least 5 other companies. This does 2 things. It either shows you that there's a much better deal out there, saving you a ton of money, or it confirms that your current company is still giving you a competitive rate. You have to keep them honest. Loyalty in the insurance world is a one-way street, and you can't afford to be on the wrong side of it. Finally, let's dig into the treasure chest for the really hidden gems. These are the discounts most agents won't even mention unless you specifically ask. First, affinity and professional discounts. Are you a member of a specific organization? A college alumni association? A credit union? A fraternity or sorority? Even certain employers or professional groups, like for teachers, engineers, or government workers, have partnership deals with insurance companies. These can be another 5 to 15% off just for being part of a group you're already in. You just have to ask, do you offer any discounts for members of your organization? Second, the defensive driving course. This is one of the best investments you can make. You can take an approved defensive driving course, often online, for a cost of maybe $25 to $50. Takes a few hours. Upon completion, you send the certificate to your insurer, and they will apply a discount to your policy, typically around 10%, that lasts for 3 years. You spend $50 once and you could save $150 a year for 3 years straight. The return on investment is massive. And the last one is brutally simple: the pay in full discount. When you get your quote, you'll see 2 prices: a monthly payment price and a pay in full price for 6 or 12 months. The monthly option always looks more manageable, but it's a trap. It almost always includes installment fees, which are basically interest charges. By paying your entire 6-month premium upfront, you can often save 5 to 10% right off the top. If you can manage the cash flow, you're essentially getting a guaranteed 10% return on your money just by paying a bill a few months early. The real magic, the ultimate strategy, isn't finding one of these discounts. It's stacking them. Imagine this: you're a B student, so you get a 15% discount. You take a defensive driving course for another 10%. You bundle with a renter's policy for another 10%. You pay in full for another 5%. And you're a safe driver using a telematics app, which gives you another 25%. You haven't changed the car you drive or the coverage you have, but by strategically stacking these power-ups, you've potentially cut your premium in half. You've beaten the game. But what if I told you that all these discounts are just a band-aid on a bigger problem? That your zip code, your credit score, and even your job title are being used against you in ways you can't imagine? In the next part, we're going to pull back the curtain on the secret scoring system insurers use and show you how to game it. It's called a credit-based insurance score. And no, it is not the same as your FICO score that a bank uses to give you a loan. This is something different, something murkier. While your regular credit score is designed to predict how likely you are to pay back a debt, your insurance score is designed to predict how likely you are to file a claim. Let that sink in. They're looking at your financial history, how you manage your money, to guess how you'll manage your car. How is that even possible? Decades ago, insurance actuaries, the mathematicians who live and breathe statistics, discovered a strange correlation. They found that people with lower credit scores, statistically speaking, filed more claims, more frequently, and for more money. The reasons are complex and heavily debated. Maybe people under financial stress are more distracted, or maybe they're more likely to file a small claim instead of paying out of pocket. But for the insurance company, the why doesn't matter, only the what. And what the data told them was this: your credit report is a crystal ball. So they created a separate, proprietary scoring algorithm. It takes the data from your credit report, your payment history, your total debt, the length of your credit history, and feeds it into a machine that spits out a single number: your insurance score. A higher score means you're a lower risk and you get a better rate. A lower score, you're a higher risk and you're going to pay for it big time. In most states, this single hidden number can have a bigger impact on your premium than your driving record. You could have 0 accidents, 0 tickets, but a low insurance score could make you look riskier than a driver with 2 DUIs and a perfect FICO score. Feels wrong, doesn't it? It feels like you're being judged on something that has nothing to do with how you drive. And you're right. But this is the game. And to win, you have to understand the rules. So let's break down exactly what they're looking for. The number 1 factor is your payment history. A single late payment on a credit card or a student loan from a year ago can be a massive red flag. To an insurer, it doesn't signal a simple mistake. It signals instability. It suggests a pattern of chaos that they believe will eventually show up on the road. Next, they look at your credit utilization. This is a fancy term for how much of your available credit you're using. Imagine you have one credit card with a $10,000 limit. If you have a $5,000 balance, your utilization is 50%. To an insurer, a high utilization ratio, anything over 30% is starting to look risky, screams financial distress. It suggests you're living on the edge, and people on the edge in their eyes make for risky drivers. That Best Buy card you open just to get a 10% discount on a TV? If you maxed it out, it might have just secretly raised your car insurance by 15%. But it gets even more invasive. They look at your zip code. This is called territorial rating. You could be the safest driver in the world, with a spotless record and a perfect insurance score. But if you move 2 blocks over, from zip code 90210 to 90211, your premium could jump by hundreds of dollars a year. Why? Because their data says your new neighborhood has more car thefts, or more traffic congestion, or even more lawyers who file more lawsuits after an accident. You haven't changed. Your driving habits haven't changed. But a line on a map has, and now you're a bigger risk. You are being judged not by your own actions, but by the collective actions of thousands of strangers who happen to live near you. And then there's the one they really don't like to talk about, your job title and education level. This is where it crosses a line for a lot of people. Insurance companies have built profiles like something out of a spy movie that correlate certain professions with risk. Statistically, they found that engineers, scientists, and pilots tend to file fewer claims, so they get better rates. On the other hand, jobs that involve high stress, late hours, or more time on the road are often penalized. They've run the numbers and decided that a doctor is statistically less likely to get into an accident than a pizza delivery driver. Is that fair? Of course not. It's a gross generalization, but it's happening every single day, buried deep inside their pricing algorithms. Your college degree, that's not just a piece of paper. To an insurer, it's a signal that you're more stable, more responsible, and therefore a better risk. So you've got this secret score, your zip code, and your job title all working against you. Feels like the system is rigged, and in many ways it is. But now that you know the rules, you can start to bend them. You can game the system. Let's start with that insurance score. First, you need to know what's on your credit report. By law, you are entitled to a free copy of your report from all 3 major bureaus, Equifax, Experian, and TransUnion, once a year. Go to annualcreditreport.com. That is the official government-mandated site. Do not go anywhere else. Get your reports and scan them for errors. A single mistake, like a debt that isn't yours or a late payment that was actually on time, could be costing you a fortune. Dispute every single error. Second, automate everything. Set up automatic payments for every single one of your bills. Your credit cards, your phone bill, your student loans. Never ever be late again. One 30-day late payment can tank your insurance score for years. Third, attack your credit utilization. If your credit card balances are high, focus on paying them down. If you can't pay them down quickly, you can try calling your credit card company and asking for a credit limit increase. If they increase your limit from $5,000 to $10,000, and your balance is still $2,000, your utilization just dropped from 40% to 20% without you paying a single penny. The algorithm sees this as a positive sign. And be strategic. If you know you're going to be shopping for car insurance in the next 3 months, do not apply for any new credit. No new credit cards, no new store cards, no new loans. Every application puts a small inquiry on your report, and a flurry of them looks like desperation to an insurer. Now, how do you game your location? You can't just lie about your address. That's insurance fraud, and it will get you in serious trouble. But you can be precise. The rate is based on your garaging address, where the car is parked most of the time. If you're a college student living in a dorm in a big city 9 months a year, but your permanent address is your parents' house in a quiet suburb, your legal garaging address may very well be your parents' home. Check the specific rules for your state and your policy. The difference could be over $1,000 a year. Also, when getting a quote, if they ask where you park, a private garage is always better than a carport, which is better than a driveway, which is a world away from parking on the street. Be honest, but be specific. And what about your job title? Again, don't lie. But you can be strategic. When you're filling out an online quote form, the job title field is often a drop-down menu. Your actual role might fit several descriptions. Are you a writer? Or are you a marketing manager? Are you a cook? Or are you a chef? These titles can fall into different risk pools. Experiment with different but still accurate job titles to see how it impacts the quote. You might be surprised. And if you have a college degree, or you're a student with a B average or better, shout it from the rooftops. There are significant discounts for education and good grades that many people forget to ask for. By managing your credit, being smart about your address, and framing your profile correctly, you are no longer a passive victim of the algorithm. You are an active player. You're taking control of the data points they use against you and turning them into advantages. You're cleaning up your credit so their secret score goes up. You're optimizing your location and profile so their risk assessment goes down. You're doing everything right. You're finally ready to get that rock-bottom, unbeatable rate. But what if I told you that even after all that, they have one last trick up their sleeve? A final hidden algorithm designed to do one thing and one thing only: figure out the absolute maximum price you are willing to pay. It has nothing to do with your risk, your car, or your driving record. It's based on a single terrifying question: how likely are you to be too lazy to switch? They call this practice price optimization, and it is the single most important concept you need to understand to not get fleeced. Insurance companies spend billions of dollars on supercomputers and data scientists to build a profile on you. They know your age, your credit history, where you shop, what websites you visit, everything. They feed all this data into an algorithm designed to calculate the exact price point at which you will complain, but ultimately do nothing. It's the sweet spot of consumer apathy. They want to raise your rates just enough to make a massive profit, but not so much that it triggers you to actually pick up the phone and shop around. It's a game of chicken, and they are betting you'll swerve first. This is what we call the loyalty tax. It is a penalty for being a good, stable customer. Think about that. In what other industry are you punished for your loyalty? If you go to the same coffee shop every day for 5 years, they give you a free latte. If you fly with the same airline, you get upgrades. But if you stay with the same car insurance company, they slowly, methodically bleed you dry. They give the best, lowest teaser rates to brand new customers to lure them in. Then with each 6-month or 1-year renewal, the price mysteriously creeps up. A few dollars here, $10 there. It's almost unnoticeable. They'll blame it on inflation or rising repair costs in your area. And sure, some of that might be true, but a huge chunk of it is the loyalty tax. They are banking on the fact that shopping for insurance is a hassle. It's annoying, it takes time, and you'd rather be doing literally anything else. And for millions of people, they are absolutely right. But not for you. Not anymore. Because you are going to defeat this system with one simple, powerful habit. You are going to become a perpetual shopper. You must treat your car insurance not as a set-it-and-forget-it utility like your water bill, but as a subscription service you constantly reevaluate, like Netflix or Spotify. If Netflix jacked up its price by 20% tomorrow, you'd immediately ask, is it still worth it? What are Hulu and Max charging? You need to apply that exact same ruthless logic to your insurance. So, how often should you do this? The answer is simple. You should shop for new car insurance quotes every single time your policy is up for renewal. No exceptions. Most policies are for 6 months. Some are for a year. About 30 to 45 days before it expires, your company will send you a renewal notice. This is your trigger. This is your bat signal. That piece of mail or email is your call to action. Do not just look at the price, sigh, and let it auto-renew. That's a surrender. That's you handing the company your wallet. You are going to take that renewal price and treat it as the first bid in an auction for your business. You should also shop for insurance anytime you have a major life change. Getting married? Shop for quotes. Moving to a new zip code? Shop for quotes. Buying a new car? Shop for quotes. Drastically changing your commute because of a new job? Shop for quotes. Any event that changes the data they have on you is an opportunity to reset the board and find a better deal. Okay, so you're committed. You're going to be a shopper. Where do you actually go to get these quotes? There are essentially 3 main avenues to buy insurance, and to be a true master of this game, you need to understand all 3. Avenue number 1 is buying direct from the insurer. These are the companies you see on TV every 5 seconds. Geico, Progressive, Liberty Mutual. You go directly to their website, you plug in all your information yourself, your name, address, VIN, social security number, and their computer spits out a quote in about 15 minutes. The pro of this method is that it's fast and you are in total control. The con is that it's incredibly repetitive. To compare 3 direct insurers, you have to fill out 3 long separate forms. Avenue number 2 is the captive agent. These are agents who work for one and only one company. Think of your local State Farm or Allstate agent. They have an office in your town, their name is on the sign, and they are an expert in that one company's products. The pro is that a good captive agent can provide excellent, personalized service. They can help you find every last discount their company offers. The massive con, of course, is that they are captive. They cannot sell you a policy from a competing company. If State Farm isn't the best price for you, your State Farm agent can't just turn around and sell you a Progressive policy instead. Their loyalty is to their employer, not necessarily to finding you the absolute lowest price on the market. Avenue number 3 is the secret weapon. This is the one most people don't know about or don't use. It's the independent agent or broker. Unlike a captive agent, an independent agent works for you. They represent dozens of different insurance companies, often a mix of big national brands and smaller regional ones you've never even heard of. You give them your information one time, and they do the shopping for you across all of their partner companies. They are a professional insurance shopper, and their service is free to you. They get paid a commission by the insurance company you ultimately choose. They have one goal: to find you the best coverage for the best price, because if they don't, you'll just go somewhere else. So what's the winning strategy? You use all three. I call it the trifecta method. First, pick one major direct insurer. Let's say Progressive, for example, and get a quote from their website. This gives you a solid competitive baseline. Second, call a captive agent from another major brand, like State Farm, that doesn't typically work with independent agents. This covers another huge slice of the market. Third, and most importantly, find a well-reviewed local independent agent. Let them run your info across their entire network of carriers. Within about an hour or two of work, you will have done something 90% of drivers never do. You'll have a quote from a top direct carrier, a top captive carrier, and a dozen other quotes from an independent agent. You will have a true panoramic view of the market. Now comes the most critical step: comparing the quotes. And I do not mean just looking at the final price. This is where everyone gets it wrong. An insurance quote is not a single number. It's a collection of a dozen numbers. You must compare them apples to apples. Get out a piece of paper or open a spreadsheet. Make columns for each quote. Your first row should be the bodily injury liability limits. Is one quote for 50/100 and another for 100/300? That's not a fair comparison. Tell the agents you want all quotes to have the exact same liability limits. Let's say 100/300/100. The next row, property damage. Then uninsured and underinsured motorist coverage. Make them all match. Then you get to your deductibles for collision and comprehensive. If one quote has a $500 deductible and another has a $1,000 deductible, of course the second one will be cheaper. You're taking on more risk. Decide what deductible you're comfortable with, say $500, and get all the quotes to reflect that exact number. Finally, look at the extras. Does one quote include rental car reimbursement and another doesn't? Does one have roadside assistance built in? Make sure you are comparing identical bundles of coverage. Only when every single limit, deductible, and add-on is exactly the same across all your quotes can you look at the final premium price and know for certain which company is truly the cheapest. And once you have that, there's one last quick check. The cheapest isn't always the best. You want to make sure the company is financially stable and has decent customer service. You don't want to save $10 a month just to sign up with a company that will be a nightmare to deal with if you have a claim. Do a quick search for the company's AM Best rating, which grades its financial health. You want a company within a rating. Also, search for its J.D. Power customer satisfaction rating, or look it up on the National Association of Insurance Commissioners Complaint Index. This takes 5 minutes and can save you a world of hurt. Now you've done it. You've shopped the market, you've compared apples to apples, and you've chosen a winner that is hundreds, maybe even thousands of dollars cheaper than your renewal offer. It's time to make the switch. And there is a very specific way to do this to avoid a critical mistake. Do not, under any circumstances, cancel your old policy before your new one is active. A lapse in coverage, even for one day, is a massive red flag that will skyrocket your rates in the future. Here's the process. Step 1. Purchase the new policy. Tell them you want the effective start date to be the exact day your old policy is set to expire. Step 2. Pay for it and get your new proof of insurance cards. You must have them in your hand or on your phone. Step 3. On the day the new policy starts, and only after you have confirmed it is active, you then call your old insurance company and tell them you want to cancel. That's it. You've seamlessly transitioned from one carrier to another, with zero lapse in coverage. You've broken free from the loyalty tax and put control right back where it belongs, with you. And just like that, you've graduated. You've gone from being a passenger in your own financial life to getting behind the wheel. Think back to when you started this journey. The jargon, deductibles, liability, comprehensive, it probably sounded like a foreign language. The process felt like navigating a maze blindfolded. But look at you now. You understand the game. You know the rules. You know how to play to win. This isn't just about saving a few $100 a year, although that's a huge win. This is about a fundamental shift in mindset. It's about realizing that you don't have to passively accept the first price you're given. You have the power to question, to compare, and to choose what's best for you. That's a skill that will serve you not just with car insurance, but with every major financial decision you make for the rest of your life. But before we hand you the keys and send you on your way, let's talk about the moment you hope never happens, but need to be prepared for. The accident. The claims process. Because having the right policy is only half the battle. Knowing how to use it is the other half. The second you're in an accident, your adrenaline is pumping, your heart is racing. It's chaos, but you need to be the calm in the storm. Here's your 4-step emergency plan. Step 1, safety first. Always. Get yourself and your vehicle to a safe location if possible. Turn on your hazard lights. Check on everyone involved. Step 2. Document everything. And I mean everything. Take photos from every angle. The damage to all cars, the license plates, the street signs, the weather conditions. Get the other driver's name, address, phone number, and most importantly, their insurance company and policy number. Don't admit fault. Don't say I'm sorry. Just state the facts. Get a police report if possible. It's an objective record of what happened. Step 3. Call your insurance company. Most have a 24/7 claims hotline or an app. This is your moment of truth. You'll give them all the information you just collected. They'll assign a claims adjuster to your case. This person is your main point of contact. Their job is to investigate the accident and determine who's at fault and how much the company will pay out. Step 4. Follow through. Cooperate with your adjuster. Be honest and provide any information they need. They'll guide you on getting your car inspected and repaired. Knowing these 4 steps turns a moment of panic into a manageable process. Now let's tackle a few more of those tricky what-ifs that trip people up. You're at the airport, renting a car, and the person behind the counter pressures you. Do you want to buy our insurance coverage? It's expensive and you freeze. Here's the secret. You might already be covered. Your personal auto insurance policy, especially if you have collision and comprehensive, often extends to rental cars. And many major credit cards offer secondary rental car insurance as a perk. Before you ever get to that counter, make 2 calls. One to your insurance agent and one to your credit card company. Ask them, does my coverage extend to a rental car? Know the answer before you go. It can save you $20 to $30 a day. Next up, gap insurance. This is a big one, especially if you're financing a brand new car. Imagine you drive your shiny new car off the lot. The second it hits the street, it depreciates. It loses value. A few months later, you get into an accident and the car is totaled. Let's say you still owe $15,000 on your car loan, but the insurance company says the car's actual cash value, what it's worth now, is only $12,000. They write you a check for $12 grand. You're left without a car and a $3,000 bill to pay off a vehicle that doesn't even exist anymore. That's the gap. Gap insurance is a special type of coverage that pays off that difference. If you're putting less than 20% down on a new car or financing for 60 months or longer, you absolutely need to ask about gap insurance. You can often buy it cheaper from your own insurance carrier than from the car dealership. And one final pro tip for those of you in a unique situation. What if you drive frequently but don't own a car? Maybe you borrow a friend's car, use a car sharing service, or rent often. You need what's called a non-owner car insurance policy. It provides you with liability coverage, protecting you financially if you're at fault in an accident. It's secondary coverage, meaning the car owner's insurance pays first, but it's a crucial safety net that's surprisingly affordable. See, the learning never stops. And that's the key. Your insurance policy isn't a trophy you put on a shelf and forget about. It's a living document that needs to adapt as your life changes. That's why you need to schedule an annual insurance checkup. Put it in your calendar right next to your birthday. Every year on that day, you're going to pull out your policy, look at your coverage, and ask yourself a few questions. Did my commute change? Did I start driving less because I work from home now? That could mean a low mileage discount. Did I get married? Married drivers are statistically safer and get lower rates. Did I buy a home? Bundling home and auto insurance is one of the biggest discounts you can get. Did my credit score go up? A better credit score can dramatically lower your premium in most states. And most importantly, you're going to spend 30 minutes shopping around every single year. Use those online comparison tools we talked about. See if the company you're with is still giving you the best deal. This 30-minute annual ritual could save you thousands of dollars over your lifetime. It's the single most powerful habit you can build as an informed insurance consumer. Think about learning to drive. Remember that first time you sat in the driver's seat? Your hands were probably sweating on the wheel. You were checking 10 different mirrors, terrified of the cars around you, trying to process a million bits of information at once. It was overwhelming. Buying insurance for the first time feels exactly the same. It's a whole new set of rules, a new language, and the stakes feel incredibly high. But what happened after a few weeks of driving? It started to become second nature. You learned to anticipate, to merge, to navigate. You stopped thinking about the mechanics of it and started focusing on the destination. You gained confidence. You gained freedom. That's what this journey has been about. We've given you the driver's education for insurance. You now understand the dashboard, your declarations page. You know the rules of the road, liability, collision, comprehensive. You know how to check your blind spots, the loyalty tax, hidden fees, unnecessary add-ons. You're no longer a nervous passenger. You are an empowered, confident driver in control of your financial journey. So what now? Your education is complete, but your journey is just beginning. The real test isn't watching this video. It's what you do next. It's taking this knowledge and putting it into action. It's pulling up those quote comparison websites right now. It's making those phone calls. It's asking the tough questions. Don't just be a consumer. Be a smart consumer. Be a skeptical consumer. Be an informed consumer. You've invested this time in yourself, and that's the greatest investment you can make. You now have a superpower that most people, even those twice your age, never learn. You have the ability to navigate a complex system designed to be confusing and come out on top. Don't ever let an insurance company make you feel small or ignorant again. You hold the power. You have the knowledge. The road ahead is yours to command. So go out there, get the coverage you deserve at a price you can afford, and build the secure financial future you've earned. Drive safely, drive smart, and most importantly, drive with the peace of mind that comes from being truly and intelligently insured.